Chinese stocks rose after new capital market guidelines. Major indices closed higher as investors interpreted the new guidelines on the country's capital market as a positive signal for the stock market. However, Hong Kong and Japanese shares were lower. At the close, the Shanghai Composite Index was up 1.25%. Japan's Nikkei and the Hang Seng Index closed 0.7% weaker. U.S. stocks sold off on Friday after a week marked by a market-moving inflation data, evolving expectations for U.S. Federal Reserve policy and looming geopolitical tensions. All three major indices fell more than 1% and registered losses on the week. The S&P 500 index notched its biggest weekly percentage loss since January, while the Dow Jones Industrial Average's weekly loss was at its steepest since March last year. The Dow Jones Industrial Average fell 1.25%. The S&P 500 losing 1.4% and the Nasdaq dropping 1.6%. To give us more perspective on the markets and help us kick off the week, we are joined by Viv Govender, who is from Rand Swiss. Viv, thank you so much for your time. In a week last week that was dominated by the CPI report, inflation expectations from the University of Michigan survey, and then we had a weekend that had geopolitical tensions. What's the market sentiment so far as we kick off this week?
Well, I mean, the US hasn't opened yet, so we don't really know the full sentiment. But thus far, I mean, our market is negative. We've seen Asia being down as well. I think right now people are just a bit nervous. We've had quite a strong rally in the US for the last, almost 6 months now, from October. And basically, despite all the bad news we've had out of there, for instance, with inflation, like you mentioned, that rally has still continued. I don't know if this particular bout of, disappointing inflation numbers or the geopolitical situation will be enough to deflate this balloon just yet.
What does all of this mean then for central banks who are trying to tame inflation if this does escalate to a wider conflict? I mean, how are you thinking about all of this as it unfolds?
Oh, if this escalates to a wider conflict, they just, set the scenario of Iran, Israel, a proper conflict, serious strikes between the two countries. What happened this weekend, even though Iran did attack Israel, they basically telegraphed the attack well in advance. They were pretty careful not to attack civilian areas and so on. And so it was more of a show attack than an actual, trying to do serious damage. But let's just say this goes into the full-on, war between the two countries. The Iranians have the ability to close up what's called the Straits of Hormuz, a piece of water just out of their border. And that would basically cut off much of the world's, or a significant chunk of the world's natural gas and oil supplies. Places would be affected in places like China and India, but other parts of the world, in Asia especially, would also be affected. They also have the ability to cut off, maybe ship travel through the Red Sea because of the relationship they have the Houthis, which was in that region. That would affect supply chains between Europe and Asia as well. And so it would be very inflationary. We'll probably see oil prices spike up, more than they would have spiked up after the Russia-Ukraine invasion. And also, I think we would see it more widespread because you'd have the Chinese economy, especially, which is kind of still the factory of the world, being really badly affected in terms of lack of energy supplies.
We kicked off U.S. earnings season on Friday with a couple of the banks reporting their numbers. So far, given the data that's come out of there, what's the main takeaway?
Couple of things. Apparently, so net interest income is down slightly, about 4%, I think, for one of the bigger banks. We are seeing, trade income rise and investment banking income rise. We've also seen over the last little while, a couple of very successful IPOs, that's initial public offerings. We have ARM, we had a couple of other companies as well being listed in the US, and they've done reasonably well. So I do think that some of the benefits of the Fed rate hikes over the last few years will be wearing off. The one thing that I think still needs to be worried about is commercial real estate. I think that's a really big problem because high interest rates like they have been over the last couple of years, many of these companies, basically, or commercial real estate companies, have some serious trouble in terms of repaying their loan. We could, if that continues for much longer, could see a bit of a dip in that sector, which would be obviously bad loans on the books of the banks.
When it comes to your interest rate calls, whether it's South Africa or the Fed, to what extent has it changed over the past few months, given all this data that we've received?
Significantly. I mean, if you look at the overall market expectations, the market is pretty much expecting a guarantee of a rate cut by July this year. 99+%. Right now, it's below 50. So the market has changed expectation. I've also changed. I mean, I was expecting 3+. Right now, I'm expecting below 3. 2 is the median. In fact, even 2 might be a bit high if we have another, sort of surprisingly high inflation number coming out from the US. And remember, we've been surprised a couple of times this year so far to the upper side. So if we have a couple more of those come through, there is a significant, not an insignificant chance. I wouldn't say it's a majority chance, but not an insignificant chance that the next rate move we see from the US could be an increase. Larry Summers, has come out recently and said that he puts it on about 10 to 15% chance right now. It's a 1 in 10 or 1 in 7% chance, so 1 in 10, 1 in 7 chance of a rate hike before a rate cut in the US. It's no minority, but it's not an insignificant minority.
Before I let you go, just quickly, we've been talking about whether the Fed needs to cut at all, given how strong the U.S. economy is. Is the Reserve Bank under any pressure to cut?
Look, we cannot not follow the Fed. We cannot basically go our own path. We are too vulnerable to international money flows, too vulnerable to export prices. The example I would give to anyone that wants to think about why can't we go our own route, look at Turkey. Turkey is a larger country than South Africa, more developed, bigger per capita income, and their currency went from 3 to 30 in a period of about 8 years. That's like upward from 20, which is 19 right now, to almost 200, basically between now and like just up 2030. A huge fall in the currency, and why? Because they disappointed the market when it came to interest rate hikes. And so, yeah, I do think that we really can't forge our own path. We can only cut once the Fed starts cutting.
Verv, thank you so much for your time this afternoon. That is Verv Govender from Rand Swiss. And as we were talking about those U.S. bank earnings, we've got Goldman Sachs topping first quarter revenue when it comes to both profit and revenue, as I mentioned. But it's been fueled here by trading and investment bank revenue.